How's it going, everyone, and welcome to our video on hedge funds. In this video I'm just going to discuss some points about hedge funds, what they do and how they approach the markets, and how they're a little different to regular funds. So let's just jump straight into it. What is a hedge fund? So online and in legal definitions you won't really find a clear definition, as there's no actual definition being thought out. But basically they're just an alternate investment vehicle using pooled funds that are meant to then employ their own strategies to generate something called alpha for their investors. And this alpha, it basically just means they're meant to generate more returns than the general market rate. And one major feature that hedge funds have is that they have far less regulation than general funds, mutual funds, and other investment vehicles. So this actually allows them to be more aggressive, using leverage on things like derivatives in both the domestic economy and even global economies. Now, hedge funds themselves, they're actually only accessible by accredited investors. Now, what does accredited mean? This means their annual income has to exceed $200,000 a year, or they must have a net worth of over 1 million. So you have to be a private investor, which is basically fairly wealthy, to actually invest in a hedge fund. That way the SEC knows that you are responsible with the money. You know that if you put it in a hedge fund, it's at high risk. Now, on a final note, they actually have a really, I'd say, expensive fee structure compared to general funds. What you'll see is they have a 2 and 20 structure, and what this means is that in general the hedge fund manager will apply a 2% asset management fee. That'll probably be an annual fee on the funds in general, no matter what returns are gained. And then they'll actually receive a 20%. Now this can increase between 20 and 50, whatever the fund sets out, on the actual profits generated from the returns. Now this 20 or 50% is actually an incentive for the hedge fund manager to achieve alpha in the markets. So these accredited investors know that the hedge fund manager is now incentivized to generate way more than the markets to cover those costs. So now you know what the hedge fund is and a little bit about the hedge funds and the structure. We'll go into understanding the hedge funds. So in the hedge funds themselves, in general, they'll apply one of these 4 type of strategies, or a various bundle of them. So the first one will be a long short equity strategy, and this is basically when they would long a stock that is expected to rise in price and then short a stock that is expected to fall in price. And then this essentially means that it minimizes their market exposure while profiting on both sides of a trade. Now, the long short method, it kind of seeks to augment traditional long only investing by taking advantage of these profits from securities that are undervalued and overvalued. So basically, let's say they'd realize that Netflix was undervalued, they'd buy that, and then Amazon, it was overvalued, so they'd sell that stock at the same time. So that's like the long short equity method. There's also the relative value strategies. Some people know this nowadays as like arbitrage. So what they'll do is they'll sell something expensive but buy something that's cheap at a similar time. And relative value arbitrage is basically a type of strategy that seeks to take advantage of these price differentials between related financial instruments. This can be things like stocks, bonds, even currencies, but what they'll do is they'll simultaneously buy and sell these different securities as they have this correlation, and they believe that there's a gap between them, and then they'll take advantage of this spread. So what about event-driven strategies? So event-driven strategies, they basically take advantage of big events, big corporate events that might come up. This can be something like a mergers or acquisitions, a takeover, or even a bankruptcy. And then what the hedge fund would do is maybe buy out this company when it's like on the brink of bankruptcy or brink of failure, and then look to restructure it and then make a profit from the restructure, because they think that the company could actually do really well once they've restructured it. And finally, there's actually the global macro approach, or a macro approach. And this strategy primarily takes advantage of using an overall economic and political view of the markets. And this is actually one of the approaches we cover in our academy to apply towards a Forex market, as that's the most applicable method. And what happens in the global macro strategy is that what you try to do is analyze trends that involve factors in things like interest rate politics, domestic and foreign policies, and currency exchange rates. So they're the major ones in global macro, and you'll take advantage of the large trending moves in currencies that way. So in general, the hedge funds, they're mostly privately owned, and obviously they're only accessible to those private investors. And then what will happen is these private investors will have really high minimum investment requirements. So you may be seeing, I don't know, some funds nowadays, you only need like a £1 deposit or a £1 deposit to get into a broker. But obviously these hedge funds will have way higher deposit margins, maybe 100,000, maybe 200,000, 50,000. It can really vary, but it's way more expensive, and it's not really a mainstream vehicle for investing. And this is actually why they have this thing called a lockup period. And what this means is that they can actually lock your funds within the hedge fund so that you can't take money out. And what this helps them do is obviously manage their risk in their portfolios and make sure you don't get scared out of taking money out. So what will happen is they might give you a period where every quarter or every 2 years they'll let you take some money out. And that's probably one of the major things about hedge funds, where this lockup period can happen, and then most of the time when it does happen, the manager takes a lot of hit for it. There's actually been one recently in the news. I forgot what fund it was. I don't think it was a hedge fund, but it was a fund, and the funds were locked up, and then it was all over the news because everyone was trying to take money out during the US-China trade war. And they locked the funds up because they thought it was the smart play, and it was in the investors' best choices. And since then, actually, the market has reached all-time highs. So it would have actually played out better for the investors to keep their money in there. Obviously, investors can be very emotional. So when this happens, in short periods of time, you'll see investors get scared. They just want to take money out, put it in somewhere safe. But the hedge fund managers know better. They have these lockup periods, and they're interested in making money for the investors and also gaining basically the commission, that 20%, as you said, on the gains they earn. So what are the key points? Well, basically the key points are that hedge funds are the alternate investment vehicle to generate alpha for private investors, not mainstream investors. You have to remember that. These guys, high fees, high minimum requirements. It's not for the general public. It's mostly for high net worth individuals or wealthy individuals. This is also due to their very expensive fee structure. So as we said before, the 2 and 20 structure, where they'll take a 2% annual fee and then a 20% fee on the profits they generate. In general, over the past, let's say, I think it's the past at least 15 years, that the number of hedge funds has been growing notoriously, and it's actually been in a lot of controversies, such as the 2008 financial crisis, and obviously the big bet George Soros made on the GBP, the day that George Soros broke the Bank of England. You'll probably have heard that somewhere. Only accredited investors can qualify to invest, and obviously, since hedge funds are less regulated than normal funds, they have a wider investment latitude compared to general funds. So they can put their money in anything such as property, derivatives, stocks, bonds, anything of that nature. And what they'll then do is they can also employ leverage. Now, what this means is they can then actually potentially earn more on the risk they take. But at the same time, they'll take on more risk, but that's a little different to the other funds out there. They can actually employ this leverage, and there's actually been a case in history where I think it was Long-Term Capital Management was a very popular fund pre-2000s, and because they're using very high leverage, they were exceeding market returns and giving a lot of alpha to their investors. But what then happened was a big crash. I think it was in Russia, and it hit them really hard because they were super over leveraged, and the Federal Reserve actually had to bail them out. So that was a really huge issue with leverage, and it actually goes to show like how dangerous leverage can be, because if they didn't get bailed out, it would have caused like a global crash. And yeah, that is it. That is it on basically the overall structure of a hedge fund, like what type of strategies they actually employ and what you can do to actually mimic them. So, as I said before, they follow four key strategies, which is the long short, the relative value, the event driven, and global macro. And for Forex trades in general, the global macro approach is probably the best and most accessible method out there that you can do as a retail trader, because things like arbitrage, they require direct market access and technology, a lot of things that these retail traders don't have. But on a global macro stage, you have access to this public information, you have access to the economic reports, and all you need to do is follow that long-term fundamental outlook of the markets to generate these fundamental ideas. And that's the most accessible one, and it's actually the one we cover in the academy. So if you're interested in following that global macro approach, creating that fundamental trade ideas, and then timing those entries with technicals, price action, and reports such as the COT, you can actually sign up for that. The link's in the bio. And yeah, thank you for watching. Please do make sure to subscribe. We're fairly new to YouTube, but we're trying to create some new content for you all and educational stuff. So yeah, and do make sure to follow us on Instagram, because we post some daily memes and some cool facts on there. So thanks for watching, everyone.